Here in Spain, Chris McCann joins us for the next 2 weeks, and given the current geopolitical situation, it's a good time to ask Chris for his insights into how the markets are reacting and to remind us of the principles of successful investing. How are you doing, Chris?
I'm very well, thanks, Howard. As we were talking earlier, it's getting a little bit steamy here in terms of temperature. But
Yes,
apart from that, I'm okay, yeah.
it's pretty hot here. It's pretty hot. Well, a few months ago, we had markets reacting to President Trump's tariff war. Is that now behind us?
Not entirely. I think tariff tensions still exist. The US recently extended a pause on the new reciprocal tariffs until the 9th of July. And apart from a truce with the UK, deals with the EU and Japan are still yet to be done. New tariffs are coming in the form of expanded duties on household appliances, steel and aluminium. And the Commerce Department, the US Commerce Department, is now initiating probes into autos, semiconductors, pharmaceuticals, lumber, and more, increasing the risk of fresh tariffs. Overall, I would say the market isn't treating this as over, but neither is it overreacting.
And what about the current situation between Israel and Iran? Have investment markets been reacting to that?
Well, I'm sure all listeners are watching events as they unfold. As regards recent developments, listeners will be aware that the US attacked Iran's three nuclear sites in Fordo, Natanz, and Isfahan. And in retaliation, Iran launched a missile attack on the US military's Al Udeid airbase in Qatar. Earlier on the same day as the Iranian attack, President Trump thanked Iran for giving the United States advance notice of the coming missile strike. Moreover, in the evening, Trump declared that the 12-day war between Israel and Iran was set to end in a ceasefire. The price of a barrel of Brent crude oil on the news plunged 11.1% to $68.49. And stock prices rallied, reflecting, I think, widespread relief that Iran staged a phony retaliation event in Qatar rather than a real one in the Strait of Hormuz. Interestingly, the Israel MSCI stock price index is up near 80% since the 27th of October 2023, which was 20 days after the Hamas raids in Israel. Predicting geopolitical developments in the Middle East is always a treacherous exercise. However, the Israeli stock market suggests to me that we may be witnessing a radical transformation of the Middle East now that Iran has been effectively denuked. We note that the consensus of industry analysts is turning more optimistic on the outlook for the top 500 largest US companies. There had been a slight dip in earnings during the spring, concerns about Mr. Trump's tariffs, but now industry analysts seem to be thinking that tariffs and tensions in the Middle East won't weigh too much on profits, if at all.
What reassurance can you give investors who are concerned about the situation escalating?
All I would say is this. Since the stock market low on the 9th of March 2009, which is around 16 years ago, the S&P 500 index has fallen by more than 5% on 30 separate occasions. Trump's tariffs and conflict in the Middle East being two of the 30 different reasons why. Regardless, over the same 16-year period to date, the S&P 500 index has increased in value by around 834%, which equates to an annualized return of around 14.6% per year. So, whatever the event, and regardless of what's causing it, a successful investor must always ignore the short-term noise and stay focused on their longer-term goals.
Can you remind us about the time, not timing investment principle?
Well, timing the market seems simple enough. You buy when prices are low and you sell when they're high. I'm afraid in practice it isn't so simple. And there is sufficient evidence to suggest that it's almost impossible. For example, I'm using 20 years of data provided by JP Morgan from 2003 to 2022. If an investor had over that period of time remained fully invested in the S&P 500, an index which is an index of the top 500 companies in the US, for the full period, they would have seen average annual returns of around 10%. Mistiming the market, even by just a few days, would have had a significant impact on an investor's returns. Now, if the investor were to have missed the 10 best days in the market during that period, they would have shed over 50% of their end portfolio value. Missing the 40 best days would take the portfolio value into negative territory, and missing 60 of the best days would have lost a striking 93% in value compared to what the portfolio would have been worth had they remained invested. So, if you happen to miss 60 best days from a total of 7,300 days, which is less than 1% of the total number of days, you would have lost 93% in value compared to remaining invested and doing nothing.
Keep calm is a motto when you hear that, isn't it?
Patience.
Keep calm and patience. Well, thanks, Chris. Next week we'll look at more principles of successful investment. In the meantime, how can people get in touch with Blevins Franks?
As always, Howard, listeners will be able to visit our website, blevinsfranks.com, where they'll be able to get the local telephone numbers of all our local partners. And they'll also be able to complete a contact form if they would prefer to, and somebody from Blevins Franks will be in touch with the most appropriate next steps.
Thanks. We'll talk next week.
I look forward to it, Howard.